The Take Action webinar series is brought to you by Clarity to Prosperity, a financial training, coaching, and IP development organization led by financial advisors, coaches, and business leaders committed to taking a holistic approach to advising. To learn more about our organization and upcoming training opportunities for financial professionals, visit claritytoprosperity.com.
Welcome, everyone. This is Jason Smith. And I'm excited. I have a co-presenter again this month with me, similar to last month. I'm going to have Bill Richardson join us. He was formerly with Allianz Insurance Company that our FMO C2P Advisory Group does business with, and we've been courting Bill for many years to join our team. Very respected in the insurance industry, and real excited to have him on board. And he's really got a phenomenal concept that we talk a lot about within our company, but he's brought some additional material and information and studies and things that I think everybody's going to get a whole lot out of that he's going to share on our webinar today. So before we get started, I want to go ahead and do a quick overview of the enterprise as a whole. And many of you who have been on these series of webinars that we hold every month, we're always coming from the perspective of Clarity to Prosperity, which is a process development, training, and coaching company. But we do have three sister companies. And so I just figured I would take about 2 minutes and give you a high-level overview of what these different companies do. So, of course, Clarity to Prosperity, the process development, training, and coaching company for financial planners. We solely offer training. I mean, training that's backed up with mentoring, a panel of mentors, which are other advisors just like us that you can gain access to and get support and get your questions answered on different programs that we built out onto an online university e-learning platform, as well as live training events that we hold just about every month. We're holding 1 or 2 live training events all around the country, and it's actual training, a little bit different than other organizations out there. Sometimes it's a sales pitch, it's a dog and pony show. We're actually doing live training, online university e-learning training, as well as the coaching and mentoring platforms that are offered. And those are strictly for fees. You pay a fee to access those different trainings and programs. Prosperity Capital Advisors is our corporate RIA. It's for those advisors out there that are looking to be an IAR of an RIA and outsource all of their compliance supervision, kind of back office operations, so they can focus on sitting in front of clients. And then, of course, C2P Advisory Group, I mentioned a moment ago. This is an insurance and annuity wholesaler where you can access fixed products through that company. And then lastly is Valor Capital Management. So Valor Capital Management is available for those of you who have RIAs or are part of an RIA. We can have a TAMP relationship with it, which is a direct relationship, or you can access us through the InvestNet platform. We're a strategist on InvestNet. We're one of the 6 national distribution TAMPs for dimensional fund advisors is what's offered through Valor Capital Management. So an evidence-based platform of investing. And so that's what our enterprise is made up of, these 4 companies. But I'm going to go ahead and switch gears now and want to get into the presentation that Bill's going to lead. And Bill, I might interrupt you once or twice just to kind of chime in or ask for clarification as you go through your presentation. But I'm going to go ahead now and turn it over to Bill. And Bill, welcome to the team and welcome to the webinar, and thanks for leading this discussion today.
Yeah, thank you, Jason. I could not be more excited. This is one of my favorite topics to discuss and something that I have spent a lot of time over the last couple of years educating advisors across the country on. So I should start by telling you, I find myself today in Minnesota. And as many of you may or may not know, we have about 3 weeks of summer here, and we cram all of the construction in 3 weeks. So if you hear some noises in the background, forgive us. We got to take advantage of it when we get it. But I want to thank everybody that's on the call for taking time out of their busy days to get some education. It is something that I never take for granted when we've got advisors that are trying to do what's in the best interest of their clients and get education. To that end, I got a quick story I want to tell when we start. So when I got into this industry back in 2004, interviewed with a number of different firms and finally got with one that I thought was going to be the winner. I get down all the way through the interview process, and I'm actually having lunch downtown Minneapolis here with the regional director of the #1 region in the country for this firm. Interview's going really well, conversation's great, good laughter, good interchange, and I'm thinking we're pretty much done with the meal. We're ready to get to the point where he's going to offer me the job. And as the last question, he asked me this. He says, "Oh, and by the way, are there any fears, or what fears do you have coming into this industry?" And I looked at him, didn't think long, and just said, "Well, actually, being perceived as a salesman." And I'll tell you, as sure as I'm sitting in front of you today, I thought he was going to reach across and punch me straight in the face, yelled at the top of his lungs, "What? That is exactly what you're going to be." I mean, the entire restaurant turned, the most awkward moment of my professional life. And as you can imagine, next 10 minutes seemed like an eternity. We finished lunch, went our separate ways, and I never spoke to him again. But what's so interesting about that is he never asked the follow-up question of why. And the why is really simple. And it's what I have based my career in this industry on, and it's why I am sincerely grateful that all of you are on the call today. I want to be an educator and an expert, a trusted advisor, and maybe even a friend to some of my clients, not a salesperson. So thanks for being with us today. I think you're going to learn some things today that are incredibly important to educate your clients on. We are in an unprecedented time in history, and we're going to talk about that. But we really need to, in this time in history, educate clients now more than ever. So let's start out. I'm going to share a couple numbers with you to start here. And let's see if we can guess along the way what these numbers represent. The first one is 10. So 10 is the number of years. Obviously, we were in a 10-year bull market. It hardly seems like, boy, how quickly we forget 2008, right? But it has been 10 years that we've been enjoying this nice ride. 15 is the next one. During that 10-year time period, we have seen a 15% annualized return in the S&P. I mean, this has been a really nice bull run that we've been on. So those two are probably pretty common, but this next one might be a little less so. The number 30. And actually, where it's currently at today is 32. That is the Shiller PE ratio. So that is the price to earnings ratio of the S&P 500 companies. And this is at a level now where we really have to start talking about it, because we've only seen it this high 2 other times in history. The first time was 1929, right before I think we all know, Great Depression. The second time that we got above 30, actually right at a little above 30 in 1929, we're at 29. And in 2000, right before the tech bubble in the lost decade, those are the only 2 other times we've seen PE ratios this high. Are we at the top? I don't know. But certainly it's worth noting we've only seen this 2 other times. The next number is 2.85. And as I checked this morning, that's actually 10 shy, 2.95. Any guesses there? That is the 10-year Treasury note. So not that unprecedented in the sense that we've seen Treasury yields go this low more than a dozen times throughout history. But what is absolutely uncharted territories is we have never in history, in 147 years of recorded history, ever seen PE ratios this high and Treasury yields this low. And so with that in mind, with that as the backdrop, I think we have to have a conversation about what does retirement planning, investing look like in an environment like this. We can't just blindly look at those facts and think that things will continue to be the same as they've always been. I think at the bare minimum, it requires us to do our due diligence on the rules of thumb and the different things that we use as assumptions to find out if they still hold true. So back in 2013, actually, the Wall Street Journal published an article, and it was a pretty bold title that caught my attention. It was "Say Goodbye to the 4% Rule." And I'm sure everybody on this call is familiar with the 4% rule. It's a rule of thumb that says that if we draw down 4% out of a portfolio, we shouldn't ever run out of money, as long as we stick to that 4%. Well, when we look at that, in 2013, again, this article comes out and says, well, that's not going to work. And what caught my attention more than even the title of the article was a bullet point, one of 3 main bullet points, right in the middle of a Wall Street Journal article that said, use annuities instead of bonds. And I was blown away. Now, in my former life, again, was an advisor for a number of years. Didn't let that first interview scorn me away. I was not averse to annuities, used them in my practice, but I'd never seen an independent third-party expert like the Wall Street Journal publish something like that. And so I geeked out a little bit, I'll be honest, and I did my research on where that came from. And where it came from was a gentleman by the name of Wade Fowle. And you'll see his name up on the top right hand of the screen. Now, Wade, as some of you may or may not know, is a professor these days at the American College. He actually wrote one of the designations that I carry around on my business card. An incredible thinker and an industry expert. And he did some research that based on where interest rates had gone and PE ratios had gone, he wanted to find out, hey, do a lot of these rules of thumb still work? And his initial research said, no, they certainly don't. Thus, the genesis of that article that I referenced. Well, he combined forces with another big powerhouse in the industry, David Blanchett. And if you haven't heard that name, he is the lead retirement researcher for Morningstar, as well as another gentleman, another academic, Michael Fink out of Texas Tech, who has a great program in financial planning. And the 3 of them took on this question, if we're retiring in this environment, what is that going to look like? And here's what they found. So first of all, let me define what you're looking at. If we're looking at the vertical, that's the probability of success of a 4% initial withdrawal rate with about a 2% inflation per year added on. If we're looking on the horizontal axis, we're looking at the percentage of equities within a portfolio. So on the far left, 0% equity, 100% bonds, all the way to the far right, 100% equity and 0% bonds. Now, the blue line on the top is your Monte Carlo simulation. This is all historical returns. And what this is saying is that in that percentage of time periods, and I'm going to come back to that language in a second, and that percentage of time periods, that 4% drawdown strategy worked. That's not necessarily your percent chance of success, but that percentage of time period that worked. And as you can see here, as long as we've got a little equity in our portfolio to help sustain that withdrawal, to help sustain that portfolio, we do pretty well. Most financial planners, I think we're looking at a 30-70 as your optimal mix there. At a 97% of time, that would work. Call it a day. We're good. But what these gentlemen deduced, and again, remember, they looked at CAPE ratios, which is your cyclically adjusted PE ratios, and they looked at interest rates. We've never seen an environment like this. And they said, well, based on where they're currently at, if we project forward, not look backwards, what's our chance of success with this 4% drawdown? As you can see here, it's pretty abysmal. As a matter of fact, the best case scenario, when we're looking at about a 70-30, 80-20 mix, which by the way is very aggressive for most retirees, as I'm sure we're all aware, there's still a 43% chance that will not work, is what these 3, again, industry experts are saying. Now, I want to mind you, none of these 3 guys are employed by, paid by, or have anything to do with insurance companies. They're just simply looking at the data and trying to figure out what's going to work for retirees moving forward. Well, this research has led to a ton of publications over the last couple of years. And I don't know if many of you have seen them. I mean, very bold ones. I mean, you look at Wade Fowle's here, why bond funds don't belong in a retirement portfolio. Certainly today, hopefully we're going to have a little bit of a balanced conversation about this. And there's going to be instances where they certainly do belong, but substituting income annuities for bond funds in retirement. And even most recently, I think this one garnered a lot of attention in the last couple of months. Roger Ibbotson coming out, fixed index annuities straight out beating out bonds. So I want to start by talking about Roger's article and just highlight a little bit of the data that he has put together. So first of all, we look at hypothetical net returns and FIAs from the 1927 through 2016, and we're comparing that to long-term government bonds and large cap stocks. And let me pause here by saying there's an industry shift that happened a number of years ago that I was very much a fan of. And that was changing the name of these products from EIAs, or equity index annuities, to FIAs, fixed index annuities, The reason I love that so much, what's the first thing that comes into your mind and therefore your client's mind when you hear equity index annuity? Well, it's equities. And yet we also know that these products are not meant to compete with equity type returns. They're really more what we're using them for in this environment. We'll talk more about this, is beating these abysmal bank returns and potentially even hedging bonds. So love that new term FIA. And you're going to hear that a lot throughout today, looking at fixed income alternative here. So annualized return, when we look at these different asset classes, standard deviation, I think really interesting as we look at both of those two and comparing long-term government bonds and FIAs pretty close. But here's where the gap starts to come in: minimum and maximum annualized 3-year returns. So over a 3-year period, long-term government bonds, the worst 3-year, we've seen negative 2.32 as your average return. Over a 3-year period, you've actually lost money there, versus an FIA, as most of us know, cannot ever go below 0 because of market performance. And then when we look at maximum annualized return, well, there's a nice upside potential there as well. So maybe something to look at. But this is really, I think, what is a more telling story relative to the conversation we're having. So I just shared some information. I'm going to share some more information on where we're at in terms of our fixed income cycle or the bond cycle. But what this is looking at is below median and above median bond return environments. And what you'll see is if we're in an above median bond return environment, long-term government bonds do very well, 9% on average in that time period, whereas FIA is only about 7.5%. Worth noting, risk premium-wise, that large cap stocks only do 9.8 in that environment. But when we look at a below median bond return environment, and I'm going to make a pretty strong case that I think that we're heading into that, the story changes pretty significantly. And as we start to introduce FIAs into a portfolio, we see not only maybe potentially increased average returns, but it's not even shown on the screen, but even more so than that, also stability of that portfolio, which, as we all know, helps manage emotions within clients that tend to make very poor decisions when that's the primary criteria, when that's the primary driver. And so I think that that's worth noting, that as you look down that column of below median bond returns, you can see why someone like a Wade Pfau would look at something like this in light of the environment we're in, looking forward and say, well, why would we bother with bonds? Again, certainly time for us to do that and certainly a place for that. But it makes sense why that would be part of his hypothesis. I want to switch gears for a second. I want to talk about, from a client perspective, why is this relevant? Why are we talking about this? What's important about this? FINRA, I'm not going to pick on them, but I do find a couple things about this funny. I don't know how many of you have seen this. About every 3 years, FINRA does a financial literacy study. And they've done 3 iterations of this now. And they're looking to get information from average Americans and find out how financially literate they are. Now, I find that a little funny because I think it could be skewed. I'm not sure how many average Americans sit around on a Saturday with their coffee and answer a financial literacy study from FINRA. So this might be kind of the cream of the crop, but at least it gives us a pulse of where America is at. So the good news is this. Well, first of all, they ask them to rate themselves on a scale of 1 to 7, and most people give themselves a, yes, 5, 6, or 7. Now, I thought they'd be rather cautious, but no, they think they're pretty smart, and for the most part, they do very well. The study reveals that there's a couple areas of concern, but for the most part, the average American is fairly financial literate. Again, self-selecting group probably, but one question, all 3 iterations of the study that has been a glaring difference is the one right in the middle of your screen. And that question is this: if interest rates rise, what will typically happen to bond prices? Now, you and I, every other financial professional worth our weight in salt know the answer to that, but look at that. Only 28% of this self-selecting group that think that they're pretty financially literate, only 28% of Americans know that. And so this is usually the point in the presentation where I pause and ask you to act. Not right now, but when you get off this call, in what ways are you going to use that information when you're working with your clients? Hopefully we'll give you some resources today, but I'm imploring advisors across the country, we've got to have this conversation, because at best, our clients don't understand that correlation, and at worst, what? They think that a rising interest rate environment could do what to their bonds? So imagine what the conversations you'll end up having with those clients when they see negatives in this environment. So as I mentioned, we all know this. As interest rates go up, there's an inverse correlation. Our bond prices go down. But investors don't know that. And for the most part, here's why. And even some advisors, if I'm being really honest, as I presented this, I actually had an advisor argue with me on this. And again, this isn't opinion. This is really just math and how it works. But I'll give a lot of financial professionals a break here. And again, I think I mentioned earlier, my job with Allianz for the last few years was traveling the country and meeting with some of the top financial advisors around the country and some of the best marketing organizations. And I commonly ask the question, how many people here have been in this business since before 1981? And as you might imagine, and even on this call, we get quite a few advisors. There's a couple, but most haven't. And that's usually the point where I'll give people a break because, yes, maybe in our Series 6 or Series 7, maybe in our professional designations, we've learned about increasing interest rate environments, but we've never lived it. We've never felt it. We've never experienced it. And so as you can see from the graph on the screen, it is a drastically different return environment. It's a drastically different place to be than where we've been over the last 35 plus years. So with that information in mind, I don't know how many of you have been out on the FINRA website. They actually have an investor website, and there is an investor alert section on that website. And in that section, there is commonly, and there has been for years now, one of the first two investor alerts has to do specifically with duration or interest rate risk. And here's why. I want to ask a question. I'm going to pause here. So think back to 2006, so just 12 years ago. What do you think, what would you guess the 6-month risk-free rate, the 6-month treasury yield was back in 2006? Now, give it an honest guess. Would it surprise you to know that that 6-month yield, the yield on a 6-month treasury back in 2006 was over 4.8%? And so in just 12 years, think about how far we've come. And so as a result of that, what I saw time and time again in meeting with different advisors across the country is they were in a process of lengthening duration. Now, granted, there's probably a lot of people on the call that are saying, no, Bill, I'm not doing that. We're in short duration. But I even had an advisor that told me that they were looking at 30-year duration bonds to try and chase some yield. FINRA knows that. They're privy to all this information. That's why they continue to warn investors. So I want to do just a little bit of homework here on what duration and how that impacts your interest rate sensitivity, because it's a big deal. So first of all, if we see a 1% rise in interest rates, and by the way, we saw a 1% rise in interest rates just from September to April. I'm not sure if everyone's aware of that. We were just south of 2.1%, and we got just right around 3.1% just a couple weeks ago. So if we have a very ultra short-term bond, a 1-year bond, not a big deal. We only see about a 1% move in a price of our bond in that case. But what happens when we extend that duration out 10 years? Now all of a sudden we have a huge impact. Let's back up the truck even a little bit farther here. So if we go back to November of 2016, what was going on back then? Think about what was happening. So we're an election year, right? We know we have an outgoing administration. We are anticipating, embracing for all kinds of equity volatility. Turns out when the dust settled at the end of the year, we actually had a pretty nice year. But what got missed in November was actually an enormous jump in the 10-year treasury. We actually saw it move in the span of just a few weeks over 80 basis points. Now looking at my screen here, what does that mean? What happened to those bonds, those 10-year duration bonds, in just that few short weeks? Well, they lost 8%. Now, I didn't hear so much about that in November, and I didn't hear so much about it in December, but January, my phone started blowing up. And as I'm out at conferences working with advisors, they're getting phone call after phone call from clients that saw what? For the first time that they could remember a negative quarterly statement from their bond portfolio. And I thought that would shake us up a little bit enough to start thinking a little differently about fixed income, but unfortunately it didn't. But that is reality. This isn't opinion, it's math. That's what happens when we've got a bond portfolio in a rising interest rate environment. So let's take a look back, just to kind of further drive home this point. Let's take a look back at the last time we've seen an increasing interest rate environment. So prior to 1981.
Bill,
Yeah.
can you back the slide up just for a second? Because the animation like kind of shot through. So on a 2% down to 800 and 3% down to 700 on a 10-year. Okay.
Yeah.
Wow. I'm surprised it's so
If you're in
directly like correlated percentage-wise, I guess.
Yeah, absolutely. And so the longer the duration, the more interest rate risk you're taking on. And that's something certainly to be thinking about. Yeah, so if you look here, and we're going to go back to 1945 here, and look at a 30-year bond, and look at the value of that 30-year bond 10 years after its issue. So 1945, we look forward 10 years to 1954, not a big deal. We haven't lost that much, about 2% of value, but certainly nobody likes to lose, again, on a bond asset that they're looking at as a safe asset. However, you can see as time goes on, that story gets significantly different. Looking at 50 to 59, here we're looking at about a 25% drop in the value of that bond over a 10-year period. Now, let me pause here. It's a 30-year bond and we're 10 years in. One of the advisors that I spoke to a couple years ago said, well, yeah, I'm buying 30-year bonds, we'll hold to duration. First of all, how many retirees are going to get 30 years of duration, quote unquote, or lifetime? And second of all, if they see a 25% drop in the first decade on that asset, what does that look like? How do those conversations go? What's the opportunity or what's the chances we keep that investor invested for the duration the way that we had planned? And you go all the way down, you keep following this down the rabbit trail. Look at 65 to 74. We lost nearly 40% of the value in 10 years. Those are the kinds of losses that we associate with equities, certainly not with fixed income, and not over a 10-year period where we're going to have losses in value. And so do I think that this is the environment we're heading into for the next 10, 20, 30 years? I don't know. But I just think that it's important that we look at environments that are more similar to the one we're currently in than the ones that we're just coming out of.
Yeah, I mean, I think it kind of is, Bill, if you figure. I mean, that's showing 45, what is that, through 80, 1980 or 81?
Or 81, yeah.
I mean, that's so similar to the environment I think we're probably in now and going into over the next 20, 30 years, a rising interest rate environment. Yeah,
absolutely.
It's important to note too, this, the yield or the interest wasn't being reinvested here, but even still, I mean, this is the actual value of the principal of the bonds.
Yeah, that's a great point, Jason. And we're not reinvesting here, but again, well, we all know one of the most difficult or challenging things we deal with is the emotions of our investors. And when they see those negatives on their statements, that takes a toll over time. And so we may have a very good plan, but our ability to keep the clients on the right track is challenging when you see things like this happen. So this is where I love talking about FIAs as a fixed income alternative. It provides, in essence, the safety that your clients want and the the safety that they really want and the income that they need. And so what we're going to do here for just a couple minutes, and we're not going to get into all the dirty details, but we are going to at least give a brief overview on what is an FIA. It's a fixed indexed annuity, and why would we position these within a portfolio? So an FIA, first of all, it's a contract between an insurance carrier and a client. So this is not an investment as defined by our regulators. It is an insurance product. As such, it's a contract between the insurance carrier and the client. Money in that FIA is going to be earned based on interest due to changes in an external index. Now, that's a mouthful, okay? But what it is not is it's not invested in an index, and we'll show you how that looks in just a second. But it's going to earn interest based on an index that is going to be subject to caps and participation rates. Okay, and in a moment, we're going to walk through some of the myths and truths here. There's a lot of misconceptions about a lot of the things I'm sharing with you, and we'll talk a little bit about that. So like variable annuities, a lot of people are familiar with variable annuities. FIAs have surrender schedules between 5 and 10 years. And also like variable annuities, some of them have optional guaranteed income benefits that look, smell, taste, feel very much like a variable annuities, except it's a key difference. The costs are usually significantly lower or zero or no additional cost. The number one selling FIA in the industry for the last couple of years actually has no additional cost to it. So that's very, very broad stroke of the brush on what an FIA is. But let's dive a little bit, just for a minute into it. What are some of the myths and what are some of the most common misconceptions over the last 7 years as I've been working in this particular line of business have I heard? This is my favorite one. If an index is 10% and the cap's 4, well, Bill, insurance company keeps 6%. That's a great deal. I love that one. So to answer that, I really want to take a look at how do these work? First of all, as I mentioned, not an investment. When your clients put money into an FIA or give it to the insurance carrier, it gets invested in a general account, an enormous general account that is full of all of the policyholders' assets. And here's what a sample, okay, this is what just a sample of what those assets look like and how they're being invested. So you can see here the portfolio mix mostly made up of high-grade corporate bonds. Okay, there's a number of different assets in here, but that's the vast majority, very, very highly rated corporate bonds, so very stable and safe. A good yield, hopefully, we can count on. Now, I'm going to kind of break down that yield that they're getting on that bond portfolio. Please understand that the numbers here are just purely just for an example purposes. But let's just say, for a hypothetical example, that our corporate bond yield is around 4% that we're getting out of that general account. So here's what happens. First of all, we have deferred acquisition costs and insurance company profits. So acquisition costs should make sense. It's lights on at the insurance building. It's sales costs, it's commissions, it's everything that goes into putting that product together. That's your deferred acquisition costs. And so that pulls out of that spread. Then there's also the profit. A good insurance company is not a nonprofit. It is actually making a profit. And so there's going to be a small spread. But what's interesting here is it's not the 6% that everybody was thinking. It's merely 44 basis points. And again, these are just hypotheticals. Normally it's around, those numbers are pretty accurate. But you can imagine, by the way, when the yields go down on bonds, how difficult it is for these carriers to provide additional benefit.
Yeah, you know what, Bill, too, I wanted to note that 44 basis points is the exact number one of the insurance companies who kind of originally kind of gave this breakdown of how we explain it. That's exactly what their profit margin is.
Yeah, absolutely. So then what we've got left over, as you can see here, is the yield remaining for the client. And this is where we look at what happens with that 2.31%. So first of all, what you'll see in almost every FIA, you'll see a fixed interest rate available for clients to invest their money into, or excuse me, not invest their money, but allocate their dollars to. And that then they're getting they know for that year they're going to get a 2.3% fixed rate for that year. So they can certainly choose that option. But on the other side, they can say, you know, we're going to give that 2.3% to you, insurance company, to potentially get some higher upside by letting you purchase options. And those options are what the insurance company uses to provide the caps and spreads on the different index options within the product. And so all that, again, just to say, we can't have unlimited upside with just 2.3%, and that's thus the caps and the spreads. But that's what the insurance company is doing behind the scenes to allow for the client to potentially get a little more yield than just that fixed rate in the product. Now, this is just, again, average index credit. Again, we're not trying to compete with equities here. I can't stress that enough. If we're getting 3, 4, 5% on an average rate of return over the life of a policy, we're doing real well for the clients, and especially in an environment that we're currently in. Okay, one of the other ones. It's not a real investment, Bill. You can't see the values. I give you my money. It goes into a black box. Who only knows what you're doing with it? Well, we already answered some of that. But here's the reality. What we're looking at here is one of the index options by one of our preferred carriers. And you can actually see this on the website daily, should you choose to. And I have a lot of advisors that maybe made the mistake of one time telling a client about this, but then they're tracking it probably a little too often. But should you choose to, you can jump on here. You can see exactly how it works. You can see exactly where it's at. You can actually compare, as you can see on the very bottom of the screen, you compare it to another index. And you can see this is actually real returns on a real product that we use that's done very well. This particular product, whatever this index does, you just subtract 80 basis points, and that's what your client gets as their credit. So, well, I hear a lot of, it's too complicated, very simple. S&P 500, it's a risk control, so they're going to manage the volatility a little bit, but that's what they're going to be able to see this daily. Fees. This is one I hear all the time too, especially for folks that are really unfamiliar with FIAs. Well, they're too high. They're 2 to 3 times more than I charge to manage money. So as I work with a lot of advisors, that magic number of about 1% plus or minus that they charge, well, they're looking at fees at 3.5%, 4% even. Well, that's traditionally more of a variable annuity conversation. I think I already alluded to this earlier. Most FIAs, if they have a fee for an optional income rider, they average around 1%, and a lot of them, as I mentioned, even the number one selling, has a built-in income rider with no additional fee. What about lack of liquidity? Now, here's where I do want to make sure that we're being fair and balanced. You don't have access when you put the money into an annuity to every single penny without a surrender charge. We'll talk about that. But you do have, in all of these products that we use at C2P Advisory Group, a free withdrawal privilege that your clients can take out money up to 10% in most cases per year. I don't know many advisors that are advising their clients to take more than that on a regular basis, and certainly where that they're going to need to, this isn't an appropriate product. But there is liquidity available within these products. Surrender schedule. I don't like locking my clients up money up for more than a decade. There used to be a lot of FIAs out there, 14, 16-year surrender schedules. It simply just isn't the case anymore. Now, most of the products we're dealing with have as little as 5 to 10-year surrender schedules. And we can accommodate that. We can choose whichever product is going to make the most sense based on the client situation. And then finally, annuitization, that's another one. Bill, in order to get any benefit out of any of the product features, I got to annuitize it. That's not the case. As I said earlier, the income benefits associated with these look, smell, feel, taste a lot like the guaranteed withdrawal benefits you're used to on a VA. And in most cases, almost all cases, you have access to that account value as a death benefit, and in some cases even have an enhanced death benefit when the client passes away, even if they started an income stream. So again, we're not covering everything that we need to know about FIAs here. We're going to, in a minute, tell you a little bit about ourselves, but at least wanted to give you a baseline of why we think these work so well and hopefully dispel some of the myths. So what do I do with all this, Bill? Where do I go? I mean, yeah, it sounds great, but I don't know much about FIAs, or I really want to be looking at these products more, but how do I do that? So C2P Advisory Group is a holistic fiduciary focused, and we're going to talk about that, comprehensive insurance offering. We're an organization here built by advisors for advisors that are looking to do what's in the best interest of their clients. And so as a result of that, we work with life, annuity, long-term care, disability, all kinds of insurance products, commission-based, fee-based, but most importantly, I think as it pertains to this conversation, through a best interest annuity screening process that I want to talk a little bit about here. So this always kills me. I'm across the country. This screen is where I see more advisors taking pictures because they love this. What I want to take a look at is actual ERISA language as it pertains to selecting an annuity provider, because I think that this is incredibly intriguing. It's not what you might think. First of all, when you're picking a provider, you must take steps calculated to obtain the safest annuity available. Isn't that interesting language? How do you define safest? Right, so there's a little ambiguity there, but certainly that's an interesting phrase that we got to take into account. Requires at a minimum that planned fiduciaries conduct an objective, thorough, and analytical search for the purposes of identifying and selecting providers from which to purchase annuities. So not just the product, but the actual provider is in question as well. So this is, I think, the one that's the biggest shock. So a fiduciary has to elevate a number of factors, not just, if you kind of scroll down here, not just their insurance ratings, but actually their claims paying ability and their credit worthiness. But you can't just rely on an insurance rating service, but that doesn't suffice to meet the requirement. So there has to be more factors involved. And then disciplined, documented process, and I'm stressing that document, of weighing benefits of safety versus higher payouts to participate. So this is just some of the ERISA language that we take into account as we come up with this process of evaluating products. And using that language, we came with some primary criteria that we use to evaluate products. And in a proprietary system that we do, we put all products through the ringer on this on a regular basis to make sure that our investment professionals are only using the products that are the best in class. First of all, if it's appropriate, income produced. Now, sometimes we're using an FIA not for the purpose of producing income. And then we can eliminate this from those criteria process. But what's the highest paycheck? Second of all, carrier strength. Again, not just ratings, but strength, meaning reserves, meaning who's the owner. Is it private equity? Is it a domiciled in America or Europe? We're looking at all those different factors to figure out who are the strongest carriers that are going to be around for the long haul. And then fees and expenses. What are the costs associated with the contract? That's obviously a hot topic over the last couple of years. We got to be cognizant of that. It's got to be a part of the equation. Accumulation potential. What is the average rate of return or expected returns we can get out of these products? And then final, very important and almost never talked about, renewal integrity. So many companies will publish the renewal rates within their products. Let me define that. So that is one of the levers in an FIA that a carrier can pull on in-force business, meaning I've got a 4% cap at issue. 5 years from now, what is that 4% cap on call it an S&P index? What does it look like? Is it still 4 or is it 1? So that's renewal integrity, and that's very important because we don't want carriers, we don't want products that are going to be a bait and switch for your clients. Those are some of the toughest conversations that I think we all know. So we talked a little bit about the process, but in addition, C2P Advisory Group, dedicated to service to advisors. I won't say much more about that. I think we all know that that's important. So we have a dedicated internal and external sales team, as well as case management and team support, but also sales resources. Jason, who is gracious enough to have me on the call, is the author of a fantastic book and a holistic planning process called the Bucket Plan, the likes of which I really wasn't seeing anywhere else in the industry, and was a big reason why I came and chose to affiliate with C2P, but a number of different resources as well to help with your sales process. So finally, if you have any questions about this, if this has spurred any thoughts or any pain points, if you really want to dig into what it might look like to look at these, as well as to there's going to be a white paper Jason's going to talk about in a minute, do reach out to us. So you can see here there's an 844 number on the screen. That's our general number. Reach out to us and let's have a conversation around what it might look like in this environment for you to look at it, FIA as a fixed income alternative.
The Take Action webinar series is brought to you by Clarity to Prosperity, a financial training, coaching, and IP development organization led by financial advisors, coaches, and business leaders committed to taking a holistic approach to advising. To learn more about our organization and upcoming training opportunities for financial professionals, visit claritytoprosperity.com.